Mohammed, the sort of perverse and interesting element of this is, we're looking at green on the screen. I mean, we're showing you red right now on Credit Suisse, but green in terms of the futures, in part on perhaps expectations that maybe the Fed pivots because they see, if they're data dependent, they see this news and say to themselves, maybe we got to take our foot off the neck of the economy.
Yeah, we got to work. We got to stop with this love affair with a pivot. We saw what it resulted in during the summer. If the Fed pivots, it's because we've had either an economic accident or a market accident. We should not be wishing for that because the journey to a pivot would be painful. I'm not surprised we're seeing green. Let's not forget how horrible September is. But Andrew, ask yourself the question, are you confident that the Fed can not only balance control of inflation and employment, but also financial stability? Because what the UK has told you is keep an eye on the third issue as well, which makes it much harder in terms of what the Fed has to do.
Hey guys, Mohammed's back with great advice. After the sterling pound and Bank of England debacle plummets to the dollar, Al-Irian is in an interview and he says, quote, buckle your seatbelts. The road ahead is going to be bumpy. End of quote. This is a strong warning from one of our finest economists. Concerns about Credit Suisse financial health reverberated across markets on Monday, feeding worries about a collapse along the lines of the Lehman Brothers in 2008 that might trigger a broader crisis. Not to say, not so fast, Mohammed said, quote, I do not think this is a Lehman moment. If a Lehman moment is defined by counterparty risks in the banking system, if you're worried about systemic risk, look at the non-banks, not the banks. End of quote. Let's continue. What the Credit Suisse and recent UK market rout in bonds and the sterling indicate is that new tightening financial conditions and central bank mistakes slowing global economy, all these other non-economic issues, there are also concerns about that market functioning after years of repressed interest rates. It's actually started to be an issue. End of quote. Share of Credit Suisse, CSGN, negative 0.93%. The Swiss banking giant and one of the most systemically important banks in the world plummeted as much as 11% to a record low on Monday as the cost of issuing its debt against a default has soared. This is a 3x Lehman Brothers and Bear Stearns, guys. This is really bad moving forward. Let's read more from Market Watch and get another advice from Mohammed Al-Irian before we ask our editor to roll clips. Quote, we need to stop with this love affair with the pivot, end of quote. Al-Irian told CNBC, quote, we saw what it resulted in during the summer. If the Feds pivot, it's because we've had either an economic accident or a market accident. We should not be wishing for that because the journey would be painful. And that's where we're going. Remember when he warned about inflation being sticky? Well, we are not only sticky. It's more like crazy glue. We are stuck at high inflation and moving up very soon. But I digress because I'm not a financial advisor. I'm just a regular Joe with an opinion. So let's hear the pros. Editor, roll clips, fair use.
So this is a bank that's really been struggling to recover from just a string of scandals and losses. So what does that strategy look like?
Well, the interim strategy, they're going to put out their turnaround strategy at the end of the month, October 27th. We do know that the CEO has been working very hard to ease investor and staff confidence in the interim, putting out this second end-of-week memo in 2 weeks as the stock fell to a new low and default swaps rose. The CEO reassuring staff the bank has a strong capital base and liquidity position. He also told the staff he plans to send them regular updates until they come out with this formal strategic plan on October 27th.
A few moments later.
Citi is out with a note on Credit Suisse. Yeah. Saying, and we talked about this, but the stock's kind of resuming some of the significant losses we saw earlier. It seemed to pull back for a bit. We would be wary of drawing parallels with banks in 2008 or Deutsche Bank in 2016. Rather than liquidity concerns, they see the current move in spreads as an inconvenience for funding costs and for private banking, obviously, and where there's a risk of further outflows on the negative media headlines. Yeah, you get wealthy clients who say, well, I got money a lot of places. Why would I keep it here? And so there is that. There's still this continued reverberation of the need for a capital raise and the idea that, they'll run out of time to some extent. I don't know. It's never good when the CEO is saying stay calm. That's never a good sign. When you need to
JP Morgan
say
told you that. Remember, he said, if you have to explain, no.
Yeah, I mean, and we can go back to Bear Stearns and things of that nature. But again, people close to the bank who are in positions of authority within the bank have told me there is not a need, or advising the bank, not a need to raise capital. That continues to seem to be the point, but the market not necessarily believing it. Those credit default swaps, as you're seeing there, haven't seen that level since 2009. Wow.
Is it now a choice between recession and financial instability, or higher inflation for longer?
So that's an important addition, I think, for certain countries, especially those who are importing the U.S. monetary policy but do not have anywhere near the robustness of the U.S. That's a real issue. Yeah, and we've got to somehow figure out how to go through this. John, you and I know that we tend to focus on interest rate risk, particularly what the Fed's going to do, and on credit risk, economic conditions, etc. We tend to ignore liquidity risk, and that is something that we need to pay a lot more attention to.
Well, we've been paying attention to that in the UK in a major way this week. Mohammed, we've seen the Bank of England driven to intervene at the long end of the gilt market. We saw the BOJ in the last week have to come in and step into the FX market, support the Japanese yen. The ECB, before any of this, had to set up an instrument to get ready to put a lid on Italian yields as they set to raise rates even further. China's been warning investors that they're willing to step in. Mohammed, we talked about this earlier this week. Who's next? Who's willing to blink, and can we get to that equilibrium, that new equilibrium, without central bank intervention every step of the way?
That's the major question. And these interventions, to be clear, are temporary. I think you used the word Band-Aid. We call it plaster here in John, but you know, these are just Band-Aids. And it tells you that the global economy is not clearing on its own, or if it's allowed to clear on its own, there's going to be a lot of collateral damage. You know my view, when you distort an economy for so long, getting out of the distortion is by definition problematic. And that is what we're learning. But we have no choice to get out of the distortion, because if we don't, the inflation issues is going to be even more problematic. I think you and I have been warning people, all of you who are looking for a pivot, be careful what you wish for, because this pivot only happens if you have an economic accident or financial accident. And the journey to an economic and financial accident is a very painful journey.
Let's start with Credit Suisse. How concerned should we be? Is the idea of this being some kind of Lehman moment or something akin to it too far, too fast?
So I do not think this is a Lehman moment. If a Lehman moment is defined about counterparty risk in the banking system, if you're worried about systemic risk, look at the non-banks, not the banks. But I agree with what Rick just said. Importantly, is look at the market reaction. It is the market reaction that's the interesting thing here. And it tells you that there's anxiety not only about the things we knew, tightening financial conditions and central bank mistakes, slowing global economy, all these other non-economic issues. There's also concern about market functioning. And that's what the UK and Credit Suisse really tell you, is that market functioning after years of repressed interest rates is starting to be an issue.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the economy and our well-being. Guys, I'm worried that these elites are playing Russian roulette. We just saw what happened with the Bank of England last week. That was with bonds, the safest place to park your capital. And they almost wiped out everyone's pension. That's scary, guys. Stay alert. The bond market is about 100 trillion. It is massive. And if the credit goes, remember, credit is 3 times bonds. This is a depression brewing currently. Prepare, prepare, prepare. They are driving in second gear and redlining.
Yeah, let's go. We killed it. Yes. Oh. Fire, fire.
and something is about to break. I just don't know when, so do your research and keep an eye on the debt markets. I will continue to bring my best so we can surf this wave, and I will do what I have to do with what I have. You guys do the same. Thank you guys for the continued support. See you on the next one. Stay free.
It ain't hard to tell. I excel, then prevail.